What's up, traders? Welcome back to Golden Forex YouTube channel. I'm very excited to bring you another PD array video. But before we get into today's video, make sure to subscribe and ring that notifications bell to stay updated with our latest videos. In the previous video, we discussed the tools we're going to be using on this channel for our forecast and technical analysis. If you haven't watched that, the link is in the description down below. Now in today's video, we will be talking about the order block and how to forecast using the order block. But before we start, here is a quick recap of the order block. Much in the same sense as a rejection block, the lowest down close candle or a series of down close candles that starts an impulsive move higher becomes the bullish order block. The bullish order block is validated when price trades above the high of the most recent bearish candle. So in this case, once price trades above this candle's high, it becomes the bullish order block. There are three key levels of interest with the order block too, and as you can see, this is an example of a series of down close candles. The first one is the high of the order block, which you can label as bullish order block high. The second level is the opening price, which is the bullish order block open. And the last level is the halfway point of the body of the candle, which is also known as bullish order block mean threshold. The inverse is true for the bearish order blocks.
Welcome back, guys. In today's video, we're going to be talking about the order block and how to forecast using the order block. Now, when we start our weekly and daily forecast, the order block is going to be one of the PD arrays that we're going to be using on a regular basis. So we're going to start by showing you guys how to forecast on a weekly chart using the order block theory. And without wasting much time, let's get into it. So from the previous video, I'm hoping that you know what an order block is. And if you don't know what it is, you can go to the main page of this YouTube channel, head over to the Genesis playlist, and inside that playlist, you're going to find a video named PD Arrays. And inside that is all the technical analysis tools we're going to be using for our forecasting. And now with that said, let's get over today's topic, which is the order block. So when we talk about order block and forecasting, this is what we mean. We look for a key turning point or area in price action where we are anticipating the market to create a swing high or a swing low. So in this instance, let's assume that we anticipated this swing high forming right here, making this our key level where we expect price to turn from. Now, once price hits that level, we wait for an order block to form. Now, from the order block section of the PD Arrays video, we know how order blocks are validated. So in this instance, once price trades below this candle's low, it validates this candle as the bearish order block. So let's mark that. Let's straighten out the trend line. All right, now before we continue, I want us to check the average number of pips this pair moves in a given week. We're going to use the 5 period and decipher that. Okay, so on average, this pair moves about 140 pips. So keep that in mind. We're going to use that as we proceed. So back to the order block. Now this candle right here validates the bearish order block. But as we can see, we wicked and closed above the open of the bearish order block, meaning that we cannot use the order block to forecast or predict our high of the week for the new week. And this bold bearish candle comes in, trades down through the order block low, validating another order block right here. Now this time we managed to close below the low of the 2 order blocks here. So in this instance, these 2 order blocks has been validated. And now we're assuming this is the current trading week. Now let's put a vertical line on it. So we're assuming that this is the current trading week. And let's hide these candles. So now, how do we forecast our high of the week? using order blocks in a bearish market condition. Now, if you will recall, we did an experiment on the average pip movement of this pair, and we found out that on average, this pair moves around 140 pips, which is from the high to the low. Now, we ask ourselves, what is a reasonable amount of pips to consider as our Judas swing, or the manipulation stage of the power of three, or the protraction? Now, when I talk about protraction, what I mean is if we're bearish from the open to the high of the week, that range is considered as the protraction stage. For protractions, I like to divide the average by 3. So in this instance, it's going to give us about 46 pips. So for Judas swings, I expect no more than 50 to 60 pips. It could be 30 pips, it could be 40, it could be 50, but it's better if it stays within the category of up to 60 pips. So now, without any chart analysis done, we have a baseline to work with for our high of the week. So this is the time we go to the charts to see if our weekly key levels, in this instance, the order blocks, will align within the average protraction that we expect. Now back to our forecast. We're assuming that this is the current trading week. And with the absence of a gap, the upcoming trading week's opening price should be the same as the previous week's closing price. So from the open of the upcoming trading week to the low of this order block is 110 pips. Now, is that a reasonable amount of protraction to anticipate if we're actually bearish? No. So we discard this order block, and that leaves us with this order block and this order block, which has been validated. So the low of this order block has been validated because we've closed below that low, and the open of this order block has also been validated because we've closed below the opening price here. So let's mark that out. All right, now that is well within our baseline of protraction from open to high, because from the open to the open of the order block is 40 pips, and to the low of this order block is 50 pips. So the low of the order block becomes our key level 1, and the open of this order block becomes our key level 2. So let's see what happens. As we can see, the market opens, trade higher, creates the high of the week within the order block low and the order block open. And from there, we create the high of the week, rejects, and trade lower through the low of this order block here, validating the low of this order block as well. We also traded through the opening of this order block, which we validated that as well. So now this week has concluded, and that leaves us with the upcoming week. Now, as we can see, with the close of this current trading week, we can see that we validated this order block as well because we traded below the low of this bearish order block. So when it comes to an order block, what are the key points of interest? We have the low, which in this instance cannot be used because we failed to close below the low of this order block, which leaves us with the open of the order block and the midpoint of that order block, and then the low of this bearish order block, because as we can see, we indeed closed below the low of this bearish order block. So for the next trading week, we have our key levels that we're going to use to forecast our high of the week. So I use 2 key levels above market price for my high of the week. So as we can see, these 2 levels here, which is the order block open and the order block low, are in close proximity with one another. So I'm going to remove the open of the order block and leave the low and the midpoint of the order block. So for the upcoming trading week, these are the two key levels that I'm interested in. So let's show the candle. And as we can see, the week opened, traded higher into premium to this order block low, creating the high of the week and rejecting, trading lower and validating this order block's low and this order block as well, because we managed to close below these two order blocks too. So now, what do we have for our forecast for the upcoming trading week? So now let's mark all the order blocks available for the upcoming trading week. As we can see, we validated this order block because we've closed below it. We have the open. We have the midpoint. We have the low. We have the open. We have this open. Now, for just next week's trading, is it reasonable for the market to open, trade all the way to this high, create the high of the week, and decline if we're bearish? No. So this one has to go. Is it reasonable to anticipate this one as well? No. It has to go. Is it also reasonable to expect a protraction of 110 pips? No. So this one has to go as well. Is it reasonable to expect a protraction of 85 pips? No. This one has to go as well. So we're now left with 1, 2, 3. Let's check which one is within the protraction rule of 60 pips. This one is 70. It has to go, leaving us with these two levels. So let's check the last one. Is it within 60? Yep, 59. So for next week's trading, this will be the two key levels that we will be anticipating price to use as a turning point or as our high of the week. So now I'm hoping by now you're grasping the idea of how to use order blocks to forecast on the weekly chart. This idea could be applied on the daily chart as well. So now, as we can see, we opened here. This was a gap opening. We opened lower, confirming that we're actually going to be bearish for the week. By bearish, I don't mean we're going to be closing with a down close candle. I mean that most of the move is going to be to the downside. So as we can see, we opened, traded higher to create the high of the week at the bearish order block open. And then we rejected, failed to go below this order block's low. We wicked, closed above this order block open as well. So at the time of this recording, this is what the current week is trading at. So that will be it for this video, and we're going to be covering the fair value gap up next. So thank you for watching this one, and see you in the next one.